Shah of Axis Bank is with us now to take us through the next few minutes and also through the opening session today. Morning, Nilesh. Good to see you in. What's your sense? We've had a 10% rally in the March series. Is this market good for more, or would you draw the line around here?
It's a slightly difficult market now. When everyone else was negative, it was quite easy to become positive. But now, after 10% rally and almost $1 billion plus of flows by FIIs on the cash side and on derivative side, you wonder whether you have reached a neutral zone and can the momentum be carried forward. From a valuation point of view, we are in a fair zone, neither cheap nor expensive. So it's a market where you have to be probably a bit more stock specific rather than broad market specific. You need to keep space if there is a correction in the market. Probably this is not the market to sell, but maybe a little higher, one can even look to book some profit.
Nilesh, morning. Any thoughts on the nature of the money? Because indications are it's that momentous ETF flows that could be running the market as it has over the last 2 weeks.
It's a bit difficult to analyze in that simplistic manner. A lot of flows have come from long only side also, as what I have gathered in the market. It's not only momentum flows which are coming for year-end consideration. There are some bottom fishing which was happening when the whole mood of the market was on the negative side. So we'll just have to see whether this trend can continue further. And if we see last year's performance, then bulk of the money which came in last year came in just 4 months. So maybe this is the beginning of that kind of trend, and we could see flows continuing going forward.
Any sense, Nilesh, at all of where this money would have come in from the last 5-6 days? I know it's very difficult to pinpoint, but what's your best guess?
My feeling is that it's not only momentous money. There was a bottom fishing done by some of the long only funds, and these are typically kind of dedicated funds which invest into a market on a contra basis. So we have seen some of the contrarian investments coming into the market.
Okay.
Nilesh, it's only after this month that we started talking about upside and new highs, etc. But are you feeling more sanguine about the fact that the downside risk has been capped for the market?
I think if the variables remain at the current level, then there is limited downside to the market. And this is notwithstanding that after 7 days of rally, there will be some small correction on the horizon. If we see the year in perspective, the index has given just about 10% return from the year beginning. And if we look at from bottom to now, it has probably given about 18% return. So on an average, where crude is up about 35%, Indian markets have still delivered the return. Next year, do we expect crude to go further higher than this, another 35% up? I think that's probably a little doubtful. So one big factor which was kind of constraining Indian equity market in terms of crude prices could be on the softening side. Interest rates more or less have remained stable. They were at the beginning of the year around 780, now it's at about 8, and we expect interest rates to remain stable going forward. So we put interest rates and crude, the two bugbear of Indian equity market, we expect them to be positively contributing next year compared to last year. And that kind of gives you much positive signal for the equity market going forward, which in turn then you can conclude that there is limited downside, notwithstanding some correction which may come, because for 7-8 days markets have continuously rallied.
What's your expectation from the broader market in April as earnings unfold? Do you think mid-caps will catch up and this may not be such a narrow rally as it has been over the last 10 days?
My feeling is that mid-caps today look far attractive compared to large cap. Large cap has rallied, and probably the valuation gap between large cap and mid-cap is tilting it in favor of mid-caps. From an earnings season point of view, clearly Jan to March 2011 quarter will be tough. It's going to face the full impact of inflation, fuel price hike, interest rate, and so on and so forth. The working capital liquidity will be very tight. So clearly there will be some disappointment as we move into the earnings seasons in April and May. However, what people will focus on is the guidance which is given or the earnings which is expected for next year, and from that there is comfort that valuations are not too expensive. They are not cheap, but they are not too expensive. So right now I will be biased towards mid cap and try to pick up those mid caps where they are not very leveraged and they are not probably as exposed to commodities. They are commodity consumers rather than commodity producers, and hopefully those basket of mid caps will do well.
We're just talking about paper, which has rallied over the last couple of days, Nilesh, after the deal which got struck yesterday. Do you think these things can act as triggers, that some strategic purchases are being made by large investors at significant premium to market prices, which might tell people that mid caps are languishing at well below their par values?
I think here it will be very, very difficult to trade. We have seen n number of times in the past with cement stocks where one small or mid or large cement company gets acquired, resulting into price increases for the rest of the companies, and then for 6 months, 12 months there is no activity, and then all those stocks keep on coming down. So if you are a trader, good luck to trade on the paper stocks. I don't think so I will be able to help you there. But if you are an investor, then probably this is not the time to buy paper companies. Maybe this is time to buy cement companies which are languishing at very low level compared to their fundamental values. And hopefully at some point of time there will be a similar activity in cement counter, and then you will benefit from there. So try to play contra in this kind of sectors. A strategic investor invariably will end up paying much higher prices than what market is paying. So try to be contra, accumulate and be a long term over there rather than trying to participate in this kind of paper rally.
A lot of the earnings cushion or upside going into the second half and indeed for the rest of this financial year, Nilesh, is premised on commodities and how they may perform. Do you think that should be the tactical shift now, to move away from these rate sensitives and start focusing on commodities instead?
I think the commodity consumers will be something which can be looked at. Globally, QE2 is coming to an end for US. They also are hitting the ceiling on the borrowing by the central government. So both these things too probably could pause sustenance of growth in US market. In Europe, we are seeing political problems resurfacing in Portugal. We have seen rating downgrades occurring for Portugal and Greece. So somewhere the growth arising out of European economy could also come under pressure. Japan obviously is suffering. And all these things put together, we could probably be reasonably sure that commodity prices which have peaked out probably should remain soft as we move towards the next couple of months. The second thing is the appreciation of rupee. India is a net commodity consumer, and appreciation of currency will be beneficial. Both these things put together, probably now the scale is tilted in favor of commodity consumers rather than commodity manufacturers. And this is how one can play in the mid caps as well as large caps.